All right, let's dive into a real financial mystery. We're talking about Meituan, the absolute giant of delivery and local services in China. They just dropped their latest earnings, and on the surface, things look pretty good. Sales are up. But here's the twist. Their profits have basically vanished into thin air. So where did all that money go? Let's figure this out.
Here it is. This is the number that sent shockwaves through the market. A 98% collapse in operating profit for Q2 2025. I mean, let that sink in. 98%. How does a company this massive, a household name, see its profits evaporate that fast? It seems impossible.
And this slide right here perfectly captures the paradox we're talking about. On one side, you have revenue growing by almost 12%. So people are definitely still using Meituan. They're ordering food, they're booking services. But on the other side, you've got this absolute catastrophe, a 98% plunge in profit. The two just don't seem to belong in the same story.
To really understand what's going on, we need to peel back the layers and get into the nitty-gritty of their latest report. Because this isn't just a tiny dip we're looking at. This is like falling off a financial cliff.
The sheer scale of the miss here is just staggering. Revenue came in strong at 91.8 billion yuan, which is great. But then you look at the operating profit, just 226 million yuan. And check out the adjusted net profit, 1.5 billion yuan. Now that might sound like a lot of money, but Wall Street was expecting almost 10 billion. This wasn't just a bad quarter, it was a complete and total shock.
So, what on earth could cause this? Was it some huge operational failure? A management disaster? Nope. The real reason for these vanishing profits is an all-out market war. A war that has completely redrawn the map of the entire industry.
You see, for years and years, the Chinese food delivery scene was a simple two-horse race. You had Meituan and you had Alibaba's LME. It was a stable, predictable duopoly. Well, that era is officially over. A new, extremely well-funded and aggressive challenger has stormed the castle, turning this into a bloody three-way free-for-all.
This table gives us a fantastic snapshot of the players. First, you've got Meituan, the king, now forced to play defense, and it's absolutely crushing their profit margins. Then there's Alibaba's Ile, who's kind of shifted gears to focus more on efficiency and just trying to lose less money. And then the disruptor, JD.com. They are just throwing money at the problem, going for aggressive growth, and it's working. They're seeing nearly 200% revenue growth in their new ventures.
And here's the result of that aggression. Meituan is still the big boss, no doubt, but JD.com, the new kid on the block, has already managed to carve out a very meaningful 5% of the entire market. Now that 5% didn't just appear from nowhere, it was ripped away from the incumbents, forcing Meituan to spend a fortune just to defend its turf.
So how exactly is this war being fought? It's not just about who can offer the cheapest noodles. Oh no, this is a complex conflict being waged on multiple fronts at the same time.
Meituan is basically in a three-front war. First, there's the consumer front. This is all about throwing money at users with subsidies and promotions to keep them on the Meituan app. Second, the rider front. You can't deliver anything without drivers, right? So they're in a fierce bidding war for delivery riders, offering higher pay. And third, the merchant front, where they're trying to lack in restaurants by giving them fancy AI tools to help run their businesses.
And as you can imagine, fighting a war on three fronts is unbelievably expensive. Look at these numbers. Sales and marketing costs exploded by over 50%. That's all those user discounts. The cost of sales, which includes paying those riders more, jumped 27%. And R&D for those AI tools for merchants, up over 17%. Every single strategic move has a massive price tag attached. And if you want to see the damage in one simple picture, here it is. This chart tells the whole story. Just 1 year ago, Meituan's main business had a super healthy profit margin of over 25%. Today, that has collapsed to just 5.7%. This is the brutal financial toll of the delivery war, right there in black and white.
Looking at all this, you have to be asking yourself, with their main profit engine getting absolutely hammered, how is Meituan even funding this fight? How are they still standing, let alone competing so hard?
Well, the answer lies in a part of their business that most people don't even think about. While food delivery gets all the headlines, it's their in-store, hotel, and travel division that is the real profit machine. Looking back, this segment, which is stuff like coupons for restaurants or booking hotels, has historically made up almost 60% of the company's gross profit. It's a high-margin cash cow.
And crucially, Meituan just confirmed in their latest report that this cash cow is still growing strong.
This is the financial bedrock of the entire company. It's the war chest, and it's funding the incredibly expensive battle happening in food delivery.
Okay, so this brings us to the end game. You've got three huge players, all backed by tech giants, all willing to burn cash. This has become a brutal war of attrition. The only question left is, who can last the longest?
And this, right here, is Meituan's ultimate weapon. The company is sitting on a mountain of cash and short-term investments, over 171 billion yuan. To put that in perspective, that's more than 23 billion US dollars. In a war of attrition, the guy with the deepest pockets usually has a pretty big advantage. And if you need a sign of just how confident management is, look at this. In the same quarter where their profits were nearly wiped out, the company was out in the market actively buying back its own stock. That is a massive signal that they believe this pain is temporary and that they have more than enough firepower to outlast everyone else.
So ultimately, there are two ways this story could end. The bull case is the survivor-takes-all scenario. Meituan uses its massive war chest to win this war of attrition, the market becomes rational again, and profits come roaring back. The bear case, though, is that JD.com's entry has permanently reset the game. Even if Meituan wins, the super high profit margins of the past might just be gone forever.
So what's the timeline here? Well, most analysts think this crazy subsidy war could last another 4 to 6 quarters. After that, the hope is that JD.com will have its foothold and shift its focus, while Alibaba keeps trying to be more efficient. By 2027, the whole battle might shift away from just price and move towards who has the best service and quality. That's when things can get profitable again.
Which leaves us with the ultimate question for anyone watching this space. There's really no doubt this brutal war will, eventually, come to an end. But the real unknown is what the industry looks like when the dust settles. Even if Meituan is still the king, will its kingdom ever be as rich and profitable as it once was? That is the multi-billion-dollar question.